Hello friends, welcome back to my channel. This is Abhijit Roy, welcome you once again. Those who don't know me, myself Abhijit Roy, I'm an ex-banker of 20 years and currently I'm trying to make you understand financial thing in a very layman language. So today we are going to discuss all about Nifty, because the market is in an all-time high position, so should we invest or what should be our way of investment sort of thing. So without wasting your time, let us go straight to find out what is the actual position as of now. So you have to find out in case of gold. If you see the gold chart also, you will find out that there is a variety of things, right? From 2015, the gold prices was 26,343. From 2016, it was around 28,623 per 10 grams. I am speaking about. 2017, it was almost 29,677. 2018, it was around 31,438. Right, and 2019 it was around 37,726, and 2020 it is 40,000, and now it is more than 50,000. So you have to suppose you want to invest and you want to earn something better. So what do you need to do? You can invest in Nifty 50, a very scientific way, right? So in terms of 2000, if you check in 2000, in the month of January, the market had given a return of 4.44%. Right. In the month of February, it had given a 7.02%. In the month of March, it had given a return of 7.64. That was negative return. In April, also it was a negative return of around 7.98%. In the month of May, it had given a negative return of 1.86%. In the month of June, 6.59 positive return. July, it was negative return 6.42%. August, it was again a positive return of 4.60. Again, in the month of September, it was negative return of 8.78%. In the month of October 2000, it was a negative return of 7.78%. In the month of November, we'll see a positive return of 8.13%. In the month of December, it was minus 0.36%. But annualized, if you check, it was around minus 14.65%, right? But if you go on checking these varieties of returns they have given, provided Nifty 50 had provided over a span of 20 odd years, you will find that there is a markup in the CAGR. If you find, it will be more than 16 to 16.5% the market has given a return. So ideally, whenever the position, what I'm suggesting you, whenever you see a good chance to enter, you should enter, whether it's in the form of SIP or whether in form of stock market and directly equity stocks. You should always invest to earn more than your fixed deposits in a longer period of time. Why I'm saying longer period of time? Because if you check in 2003, the month had started with a negative return of minus 4.72 in January. Around February, it was 2.07. That was a positive return. In the month of March, again it dipped to 8.01%. In the month of April, again it dipped to 4.51%. In the month of May, it was around 7.79 positive return. In the month of June, it was a positive return of 12.65. Right. In the month of July, it also had a positive return of 4.56%. August, it had an extraordinary return of 14.39%. Again, in the month of September, it had a positive return of 4.46%. October, 2.79%. November, 3.81%. December, it was 16.38%. So overall, the year ended with a 71.90%. Right. So this was probably the best return in the last 4 years. If you check from 2000 to 2003. Again, in the year 2004, overall you will find that the return was 10.68%. In the year 2005, if I check an analyzed return, it was around 36.34%, which was also decent. If you see through the numbers, it was also a good number, better than your fixed deposits rates. Right. If you check in 2006, it was again almost 39.83%. In the year 2007, it was 54%. Right. So the returns is always high. In case of, if you are a very conservative investor, you should go on for SIPs, because what happens in case the market goes down? So in that case, your unit allocated to you is given more, right? So at the end of a certain period, if you want to go for a longer period, you will find a better return. So that's the reason we almost say that you should invest in a share market or any form of stock market So you should be going for a longer time. In the year 2008, there was a turbulence, so that's the reason you will find a negative return of minus 51%, 0.79. In the year 2009, again, it held to 75% was the annualized return over from January to March. Right. In 2010 also it was around 17.95. In the year 2011, so it was negative return. It was negative return of minus 24.62%. In the year 2012, you will find a positive return out here. It was on 27.70. In the year 2014 also there was a positive return of 31.39%. Again in the year 2017 there was a positive return of 28.65%. Right. Again in the year that what I'm saying, I'm talking only about the double digit return basically, right? Because you also had a better return in 2018, you had a very good return in 2019, which was almost 12.02%. In the year 2020, 14.90%. Again in the year 2021, that given a return of 24.12%. Right. Again 2023, if you check, well, last year also the return was around 19.42%. So if you check this 20 years I have taken into account, that 23 years rather, so you will find how many negative things are there, negative return. So one is there, 2, 3, 4, 5, hardly 5 to 6 returns that have given a negative return. So what you can do, if you collect, if you recollect also, you will find that market gives a better return at any point of time, but you have to stay invested for a longer time. So I hope this short video will be liked by you. In case you like this video, do like, share and subscribe my channel. Thanks a lot once again.